All right, let's dive right in. Today, we are doing a complete, unabridged deep dive into one of the biggest stories in the entire market, Meta's colossal gamble on artificial intelligence, all laid bare in their Q4 2025 earnings. Now, this isn't just a quick summary. We've gone through the earnings reports, the press releases, the full analyst call, all of it, to give you a feature-length analysis. Our goal is that by the end of this, you'll understand the numbers, the strategy, and the story behind them so well, you won't need to read a single source document. So let's get into it. So here's our roadmap for this deep dive. We're breaking it down into 6 sections. First, we'll cover Meta's basic business model. You have to understand how the company is structured today. Then, we'll analyze their revenue and growth, followed by a hard look at their profitability, the story of where all that money is going. After that, we'll check out their balance sheet and cash flow, what we'll call their financial fortress. Then, we'll get into management's vision and their guidance for the future. And finally, we'll put all the pieces together for a final verdict. Okay, first things first. Before we can even start talking about the billions and billions of dollars in revenue and expenses, you absolutely have to understand the fundamental structure of Meta. The way I want you to think about it is as 2 completely different companies operating under one umbrella. Seriously, if you get this one concept, the rest of their entire financial story will just click into place. To get started, just let this number sink in for a second. 3.58 times billion. That's billion with a B. That's how many human beings used one of Meta's apps every single day at the end of last year. And that's not a stagnant number. It's up 7% from the year before. We are literally talking about a huge chunk of the world's population. This massive, engaged audience. This is the bedrock. Everything else we're going to talk about is built on this foundation. And here is that 2-company structure I was talking about. This is the key. On one side, you have the family of apps, or FOA. Think of this as the golden goose. It's Facebook, Instagram, WhatsApp, all the apps you know. It's an incredibly mature and wildly profitable advertising business that just prints cash. Then, on the other side, you have Reality Labs, or RL. This is the big, risky, world-changing bet on the future. This is the moonshot. It's where they pour billions and billions of dollars into developing the next generation of computing. Virtual reality, augmented reality, AI glasses, you name it. This split, the profit engine funding the future bet, is the single most important concept for understanding Meta's finances. All right, so with that 2-part structure in mind, let's talk about the money coming in, the top line. The headline number that had everybody talking was this monster 24% jump in revenue in a single quarter. So the question is, where did all that growth come from? Let's peel back the onion. Okay, and here you can see that 2 companies' story playing out perfectly in the numbers. Total revenue was nearly $60 billion, a 24% pop. Now look where it came from. Almost all of it, $58.9 billion, came from the family of apps, which grew even faster at 25%. No surprise, that's mostly ads. But then you look at Reality Labs, and its revenue actually went down 12%. Now, don't panic. This was totally expected. The company's CFO, Susan Lee, pointed out on the call that they were just up against a tough comparison because the very popular Quest 3S headset launched in the same quarter last year. So let's dig into that 24% ad growth because this is fascinating. How did they do it? Did they just jack up prices on advertisers? Well, not really. This chart breaks it down perfectly. The actual number of ads they showed, what they call impressions, grew by a huge 18%. The average price for each of those ads? That only went up by 6%. So the takeaway is huge. The main reason their revenue exploded wasn't price hikes. It was because they were able to show way more ads. That means the growth is coming from a healthier place, a more engaged user base. So the obvious question is, how did they magically show 18% more ads? Well, we don't have to guess. The CFO, Susan Lee, told us exactly why. She said it was driven primarily by engagement and user growth. It's that simple. People are spending more time on their apps, and that creates more opportunities to show them ads. She mentions ad load optimizations, which is just them tweaking how many ads you see, but the real story, the main driver, is just more engagement. And here is the proof in the pudding. This is the why behind that engagement. And the common thread here is AI. Their investments in AI are making their products better, which makes people stick around longer. Look at these stats. Reels watch time in the US is up over 30%. Facebook video, double-digit growth. Their AI-powered ranking systems on Facebook got people to watch 7% more stuff. Even Threads is getting a boost. And these new AI features, like automatically dubbing videos into other languages, are being watched by hundreds of millions of people. It all adds up to a simple flywheel. Better AI leads to more engagement, and more engagement means more space to sell ads. Okay, so the money coming in the door looks fantastic, but that's only half the story. Now we have to look at the money going out the door. And this, my friends, is where the story gets really dramatic because it shows you the true scale of this AI gamble. Whoa, just look at that contrast. Revenue was up a strong 24%, right? Well, their total expenses were up a staggering 40%. 40! So what happens when your costs grow way faster than your sales? Your profit margin gets squeezed. You can see it right there. Their operating margin fell from 48% all the way down to 41%. That means for every dollar in sales, they're keeping 7 cents less in profit than they were just a year ago. That is a huge move. So where is all that cash going? Well, the CFO broke it down into three main buckets. The biggest piece of the pie is infrastructure costs. We're talking about a mountain of computer servers and data centers to power all this AI. The second piece is people. You want to build the best AI in the world, you got to hire the smartest, most expensive talent. And the third piece was higher legal expenses this year. But make no mistake, it's mostly about the hardware and the talent for the AI push. Okay, now this slide. If you only remember one slide from this entire deep dive, make it this one. This is the whole strategy in a nutshell. Look at that. In just 3 months, the Family of Apps business generated almost $31 billion in pure profit. It is an unbelievable cash machine. So what did they do with that profit? They took a huge chunk of it, $6 billion, and poured it directly into the Reality Labs furnace, which lost $6 billion. This isn't a mistake. This is the entire plan. Use the ridiculously profitable social media empire to fund a massive, decade-long bet on building the future. All right, you can't make these kinds of multi-billion-dollar bets on the future unless you have an absolutely rock-solid financial foundation. So now let's take a look at the balance sheet and cash flow statements to see just how strong Meta's financial fortress truly is. I mean, just look at this number. This is the cash machine in action. Even after spending all that money on new servers and expensive AI engineers, the business still generated over $14 billion in pure leftover cash in just 3 months. This is what we call free cash flow. It's an almost unimaginable amount of financial firepower being generated every single quarter. And all that cash flow just keeps piling up. This right here is the war chest. At the end of the year, Meta was sitting on over $81 billion in cash and other liquid investments. When you have this much cash, you can do pretty much whatever you want. You can fund your Reality Labs dream for a decade without even breaking a sweat. It gives them incredible flexibility. Now, they do have a good bit of debt, almost $59 billion. But honestly, when you're generating cash the way they are, that's a totally manageable number. In fact, the CFO even said they're so financially strong that they might even take on more debt if they can get it cheaply, just to add even more fuel to their investment fire. That's a position of strength. You hear the term free cash flow thrown around all the time, so I just want to quickly demystify it for you. It's really simple. You start with all the cash the business operations brought in the door, in this case $36.2 billion. Then you subtract the money they spent on big physical stuff like servers and buildings. That was $21.4 billion. Subtract a bit more for lease payments. And what's left over? That's your free cash flow, that $14.1 billion. It's the pure cash profit after all the necessary reinvestment is done. Okay, so we've covered the business model, the revenue, the profits, the financial strength. We get the now. So let's turn to the future. What is management actually telling us? What is the grand plan here? Let's use their own words and their official financial guidance to figure out where this is all headed. And this quote from Mark Zuckerberg really is the whole thing. This is the grand vision. He's not just talking about a better chatbot. He's talking about personal superintelligence. It sounds like something out of a science fiction movie, right? But what he means is an AI that truly knows you, understands your context, and can act as a uniquely helpful assistant in your life. This is the North Star. This vision is the why behind all the billions in spending we're seeing. Of course, the folks on Wall Street hear this grand vision, and they have a very practical question. This one from Brian Nowak at Morgan Stanley is perfect. He's basically asking, okay, Mark, great vision, but how are you actually going to make money from it? Where is the return on all this investment going to come from? It's the multi-billion-dollar question on every investor's mind. And Zuck's answer here is really clear and breaks it down into 2 parts. First, he says they're going to use this AI to just supercharge the business they already have, make the ad targeting better, make the recommendation feeds more engaging, basically make the current cash machine run even faster and more efficiently.
But the second part is the really exciting one. He says they're going to create brand new business opportunities. He's talking about things like subscriptions for powerful AI agents or totally new kinds of commerce and advertising that don't even exist yet.
And what's really cool is that this AI push isn't just about their external products. It's about changing how Meta itself works on the inside. They're building AI tools for their own employees, and they're already seeing a 30% productivity boost for their engineers. For the people who really embrace it, it's an 80% boost. The ultimate goal here is to get to a point where one single brilliant person can do the work that used to take a huge team. That's a massive competitive advantage. And now for the truly mind-bending numbers. This is their official plan for 2026. Revenue guidance for the first quarter is strong, but just look at the spending. Total expenses for the year, up to $169 billion. And then there's the big one, capital expenditures. That's the spending on servers and data centers. They plan to spend between $115 and $135 billion in a single year. That's not just a lot of money. That is one of the largest corporate investment cycles in history. Now, when a company announces a spending plan that big, investors can get pretty nervous. But, and this is the most important but of the entire earnings call, the CFO immediately followed up with this critical commitment. She said that even with that record-breaking spending, they fully expect to make more operating profit in 2026 than they did in 2025. This is the guardrail. This tells investors that while the bet is massive, it is a disciplined one. They are not just lighting money on fire, they are investing for profitable growth.
All right, we have been through the whole story. The business model, the booming revenue, the skyrocketing costs, the fortress balance sheet, and the hugely ambitious vision for the future. So, what's the bottom line? Let's bring it all together and synthesize everything we've learned into a final verdict.
To help us frame our conclusion, I want to use one really powerful financial metric. It's called the self-sustainable growth rate. Now, that sounds complicated, but the idea is actually super simple. It just answers one question. How fast can this company grow using only the profits it generates itself, without having to sell more stock or anything? A high number here tells you that you're looking at a powerful self-funding engine.
And for 2025, Meta's self-sustainable growth rate calculates out to about 27.5%. Now, for a company of this enormous size, that number is just incredible. It's off the charts high. It confirms what we've been seeing. This is a monstrously profitable, self-funding machine that can easily support its own rapid growth and fund these huge new bets at the same time. This is the financial engine that makes the whole AI gamble possible. So with all that in mind, our final verdict on the state of the business is improving. And there are 3 very clear data-backed reasons for this. Reason 1, the AI investment is already working. This isn't some far-off dream. It's feeling real revenue acceleration right now. Reason 2, the massive reinvestment is disciplined. That promise to grow profits, even while spending record amounts of cash, provides a crucial guardrail for investors. And reason 3, we're seeing a smart strategic pivot. They're signaling that the crazy losses in Reality Labs have peaked, while at the same time they're building out multiple new ways to make money from AI, creating a ton of future options for the company. And so we will leave you with this final thought. The core business is firing on all cylinders, the financial fortress is stronger than ever, and management is taking all of that strength and reinvesting it into one of the most ambitious bets in corporate history. It all comes down to this one final $135 billion question. Can this grand vision of personal superintelligence actually generate enough profit in the future to justify this historic level of investment? The answer to that question is going to define the next decade for Meta and maybe for the entire tech industry.